right, so we are looking at the E-mini S&P futures contract for March delivery 2023. And in the upper left-hand corner, this one up here, that's the hourly chart, and the lower left is the 15-minute time frame, and the larger chart to the right is the 1-minute chart. All the same market, just different time frames. While I'm talking about this, I'm watching the 4032 level. There's buy side up there. So as I'm talking to you, I'm just thinking out loud. It doesn't mean I'm taking a trade. I've already done for today, and I'll show you why I did what I did, and we'll go over that. But this area here, it looks like resistance to retail traders. So whenever the market looks smooth like this, I have an expression I like to use all the time. Smooth edges like to be made jagged in the marketplace. Much in the same vein, you see these relative equal lows. The market goes through them multiple times and then reacts. This level in response to this shaded area, I'll cover that also because I mentioned that in a tweet before the fact too. But I want you to think about how the things I'm showing in my tweets and in my recordings and my executions, because you're seeing one right here, it's based on things that repeat over and over again algorithmically in price. The price generates movements and price runs based on the first premise of time. If it's not the correct time of day, day of week, it's not going to deliver a specific way, whether it be bullish or bearish. Certain times the markets are predisposed to go into consolidation and range bound. That's an important factor of understanding why time is a crucial element to knowing what you're learning here. This is algorithmic theory. I'm going to show you an indicator. Okay, this is one of my top secret indicators. You ready? Look at that. That's crazy, right? This is not oversold. This is just simply the price on a line chart on the low of the NASDAQ. Okay, you can create this on TradingView. If you're using TradingView, up in the upper left-hand corner, there's a little plus symbol. If you click on that, it'll give you the opportunity to add another instrument. So this chart here above is the E-mini S&P futures contract. And all I did was compared the NASDAQ comparably, and I clicked on new pane. New pane puts it down here. It's plotted on the closing. I'm sorry, it's plotted on the low on a line chart. When you first open this up and you do an overlay like this and compare, it defaults to the closing price. You don't want that. So when you're bullish, or if I'm bullish, I'm comparing and contrasting the relationship between the lows of the S&P versus the lows of the NASDAQ. And you can see how we were going below these lows here, dropped down here, but we didn't see that same thing occurring down here. We had higher lows forming in the NASDAQ. That's SMT. I mentioned that this morning in my first tweet. I said there's decoupling in the stock indices, and there's S&P divergence at the lows on on the S&P here, and that of the NASDAQ. So that set the stage for the manipulation aspect that I felt that was worth taking on the risk of going long. So if I'm seeing price, not an indicator, that's all this is, I'm comparing actual price action of closely correlated markets. I'm looking at the relationship of years, decades of experience looking at when this occurs around the opening, at the opening bell at 9:30 in the morning, New York time. If I see that, and there is something like this existing in price action, which is these relative equal highs, that's a smooth area in price action. The market does not like to leave smooth edges. Now, by itself, doesn't mean much at all. But when you couple that with the fact that the market's been going down, and then as this is going lower here, we've taken out a smooth area here. This is going to be viewed as what in retail mindset? Support, right? And then when it breaks through it, traders that would look for this level here as support, and they don't want to trust that it's going to go higher there, they expect it to break. They want to see that support broken, turn what? Resistance. So how are they going to be right about their trade? They're going to wait for it to come back up into this level here, and they're going to try to go short. So the traders that are in the market up here, short, they're right if it never goes back up to this level here. I'm not worried about being right or wrong. I'm looking to devour, to consume the less informed traders. Right here, there's your buy side next. Let me make sure I have it on the chart over here. Sorry, getting lost in my discussion. So there's buy side liquidity at 40, 41, 50. Gun to my head, maybe a higher high looks likely on this one. I don't know if it wants to run this high here on the 15-minute time frame. Let me just drop a line on that just for. I'll refer back to that later on. My stomach's talking to me saying it's time to have lunch. Let's see here. Take a look at the Dow. I don't trade this instrument, but I do use it for like the dollar index when I'm using dollar for like a barometer for Forex, which I'm not actively trading anymore. So if we have the you can see it's not a market replay, by the way. So we had the SMT divergence down here, and that is here. We have the lower lows, but not seen in the NASDAQ. You see that? So this is an SMT divergence. And what this is, what's actually occurring here, as the S&P market is dropping lower, it's going below this sell side liquidity here. So I'm going to annotate that real quick so you can see and follow the logic. It's what's going on in my head as the trader. Below here is sell stops. Okay, so that's what we call sell side liquidity. So the market taps into that here, and then once more here, and right there, we're getting divergence between the lows of the NASDAQ, and I'll show you what that looks like with the candlestick real quick. See how we went lower here? This low, this low, this low, respectively. On the NASDAQ, it's higher each, okay? So it didn't make a lower low on this pass on NASDAQ, which is the lower chart I'm pointing to, at the same time that the S&P went lower. So that's what I call SMT. But that divergence there was enough for me to look at this liquidity as a raid, especially if we run a short-term high, which is what we get. Let me minimize this. That short-term high right there, it runs through it there. Once it runs through it, let me zoom in a little bit more. All right, this short-term high right there, we run through it there, that candle. So we have technically a shift in market structure that's bullish. Now, a shift in market structure, this is for your notes. Oh, you didn't bring a notepad. Oh, send yourself a text. A market structure shift is just a short-term change in market sentiment, and it will deliver on a short-term basis. A market structure break is where the entire tide of the marketplace changes, and we go into a longer, higher time frame delivery of price, where if it's been bullish, and then we have a break in market structure that's bearish, then what we're saying is there's a change in trend, if you want to call it in retail logic. A shift in market structure is not equivalent to an outright reversal. It's just a change in short-term market sentiment. And that's all we need to capitalize on in terms of intraday price action. So when we see the short-term high changing here, right there, that candle, once it passes through it, I never, this is for your notes also, a shift in market structure does not require a higher close above the short-term high. It just needs to trade above it. The algorithm is not basing its next run on price because it closes above that. It just needs to run through it. Once it does that, that trigger now starts a macro. A macro is a short list of instructions that the algorithm will run in the price engine that creates these fluctuations in price. So once we get below the sell side here, We run through this short-term high. There's a shift in market structure. Now it's bullish. So your eye goes to what? My eye goes to where's liquidity. So the first thing I want to look for as I pan back is I want to look for, is there a relative equal high, something smooth? Well, these highs are basically almost the same, right? So it feels like a ceiling. If you're in your room, if you're indoors right now, look up. You see the ceiling where you're at? That's like being down here, looking up to the ceiling. That's the ceiling right there. Retail thinks that's the highest it can go because that's what the books tell them. They say in their mind, okay, this is the highest it can go because that's resistance. I train you to think it's going there and going above it because that's exactly where the money's resting. That's where the victims are holding up signs. I'm heading to Loserville. Give me a ride. Okay. That's a hitchhiker I want to pick up every time. When the market trades down to the sell side here, and then I'm watching, does it shift bullishly? There's a shift in market structure with that candle right there. It does not need to close above it. So now in my mind, I go back through what just took place. Well, we just ran sell side. We have SMT divergence, not using an indicator, just comparing correlated markets. The Dow, the NASDAQ, and the S&P. I'm comparing the price action between those those three instruments. If I'm anticipating the likelihood of something bullish, I'm already expecting the SMT. I'm not using the divergence as a trade selection. It's a confirmation tool. It qualifies something that I had already anticipated. This was too smooth. We were going below sell side. We went through it. If it went through it and we didn't diverge, and if the NASDAQ made lower lows with the S&P, then I would not expect this. So now some of you are probably thinking, can you just tell me what you were trusting and what you wouldn't have trusted? I just told you. If the NASDAQ would have made a lower low like it did here in the S&P, I would not have gone long even if it went above that short-term high here, because then I would have expected this fair value gap to be something to be monitoring. But because we had that divergence with the NASDAQ lows not meeting the lower low that we see in the S&P here, then I want to watch and see, does it show its hand to me? Does it tip its hand to me and say, Michael, this is what I'm about to do. I'm going higher. Get on board. I'm going to give you a fair value gap. It runs above the short-term high here, there, and as it's coded, just like it's supposed to, this candle's high. Look at this price here, okay? Right up here. This candle's high, and this candle's low. That's what I'm framing here. That's the fair value gap. Now, it drops down. What time is this? 9:45. That's when I told you the news was coming out. Now, that news report, I'm not afraid of that kind of report. It's not the same thing like a CPI. CPI will rip your face off. Like it's you do not ever want to be trading ahead of the CPI number. Ever. You don't ever want to be trading ahead of a rate announcement. Ever. Because it will tear your limbs off. You don't want to do that. But other market reports, they will just be fuel to something you already anticipate and see. So this 9:45 candle, notice it does wick through the fair value gap, but does it take out the low? No. Your stop could originate here at that low, buying this candle's low. That's your first entry. You can use that. You can use the consequent encroachment, which is the midpoint of the gap, which is this one candle. So when I'm talking about things on Twitter, I'll say ES 1 minute chart, and then I'll give a 09:42. I'm not saying I did it for this one here, but the other ones I'm going to refer to, I did. If I'm telling you 09:42 and I'm telling you 1 minute ES, I'm telling you to look at the ES chart, find that time on the axis at the bottom of the chart, and put it right on that candle, and you'll see exactly what I'm looking at. I won't have to say this is a buy. I won't have to say this is a sell. I'm just saying watch that. Note that, because you want to annotate that in your chart. And then watch how price reacts and goes towards what we're looking for, which was, I tweeted, After the SMT divergence, I said, note the 4028 level. That's buy side. So the market dips back down into this area here on the news, comes back up, and the candle closes here. The next candle opens, trades one more time. What's it trading into? The fair value gap one more time. This is the only other opportunity you have. If you're going to be using that fair value gap, you got to buy it, smack it right as it goes into that candle's low right there. It goes a little bit past it, but not much. But what is it really reaching for? Look at this wick from the from the low of the body, which is the closing price, to that low. Eyeball half of it. Boom. And it's also inside the fair value gap. Then it rips through this short-term high. This is a bullish breaker. What is that? The low here makes the high, and then a lower low. So this move up, you were focusing on the highest up close candle. Extend that range out. So as it's digging into this here, this is a return into that bullish breaker. If, okay, this is what some of my trolls and detractors like to say. Oh, this is only an old high. It's resistance, broken, turn support. Here's how you classify retail support resistance as the real levels to be trusting, okay? If that high has a low prior to it and a lower low after it, after this high forms, then it comes back down to it, then yes, you can trust it as resistance, broken, turn support. The narrative behind why it should be that way is what makes my breaker the breaker. It broke anyone that was holding stops below here. It went lower than that and then ripped through the short-term high. This in itself is a shift in market structure. Notice that? Same event is occurring with this short-term high here when that candle passes through it, is occurring with this high, with this movement right there. The logic is that we've done damage with this candle being a high here. It took out and broke. It broke the backs of anyone trying to go long on that low. When it ripped up higher like this, then it went down one more time to knock them out. There's liquidity taken here and absorbed. What kind? Sell side. Who would want to take out sell side? Individuals that want to go long. Smart money. Buying those sell stops up. They're being counterparty to it. And then using the fair value gap as it drops into here. And then one more time here. And it rips through the short-term high here. Let me take this off. And it comes right back down into that high. But more specifically, it's a bullish breaker. And old high, yes. And there's a fair value gap right there. You have three things qualifying that level. So when we trade back down into this high with the fair value gap and it's a breaker, look at the perfect close. Look at this right here. Look at this price right there, folks. Watch that price. On this candle's high, what is the high of that? 4020.50. This movement back down into the fair value gap, what's the low of that candle? 4020.50. This right here by itself is a trade. It moves from 421.50, which we'll just do the low. You could have went long on that at the low using the logic I already taught. I'm not cherry picking anything here. 40.21 All it has to do is trade to that level there. You could be a buyer. From 40.21 right there. It doesn't even have to go into the old highs back here, which is what it was going to be aiming for. But this candle here, as soon as it trades to 26.25, right there, that price right there, bumping above these relative equal highs right there, that's 5 handles. And you don't need to be right about trading to the buy side liquidity. That's the difference between worrying about profitability versus being right. You can be a buyer down here on the breaker in the fair value gap, run the short-term high and not need these highs to be taken out. If you can get 5 handles in that, guess what? That's exactly how you start. That's how you start. That's your first rung objective. Your expectations on what it is that you're trying to do as a trader, that's what you're trying to do. Know where it's likely to go, what you're reaching for. Where's the market more likely to go? I'm giving you that with my tweets. I'm telling you where the market's likely to go to next. It won't be 100% of the time. But 5 handles is an easy, low-hanging fruit objective. But once it clears those buy stops here above those highs, right in here, paid the trader. That was the tweet that came out. 40.28 hit, done, booked. It's over. Move to the sideline. Let's take a look at the hourly chart here. All right, so I tweeted this also. I said, pull up on your hourly chart, your 60-minute chart, the Monday 23rd of January's hourly candle. Note that that's a fair value gap. Okay, that rectangle is the same rectangle that's being shown over here. This chart that I'm looking at, the big one on the right hand side, that's a 1 minute. This same market is over here, just being viewed from an hourly chart. So every candle represents the interval of the highest high and the lowest low of each hour. The candle on the bottom lower left, each candle represents the highest high and the lowest low of every 15-minute candle. You can see that rectangle here. If I take it off, watch, it disappears from the other charts. If I Control Z, they'll go back. So it's going down to that level based on the hourly chart. It trades down to it here. It trades down to it here. That reaction is what I tweeted. I said, note that when we were inside the fair value gap here. I taught last night that you can look for inversion levels. If you extend the fair value gap in time, look where the bodies are collected inside the fair value gap. It trades right back up to this candle's low, does it here, hits it, hits it, hits it, hits it, breaks lower. Goes exactly where I said in a tweet on Twitter, the hourly fair value gap. There's 5 handles there. So 10 handles offered without really expecting a lot in terms of risk. There's risk every time you take a trade, obviously, but in terms of movement against the idea that once I tweeted it, very little fluctuation or what would be considered drawdown. The market then rallies, returns back up into the area of what? Let me go make this larger again. It returns back to this pool of liquidity there. Then it comes right back down into this right here. Take this off. This candle here and this candle here is one order block. The market, when it trades back to this level here, you want to take the opening price, extend it out in time. I hope you guys like this. I'm having fun today. Hope you're learning something. Give me a tweet and tell me if you're having fun. All right, so this order block, okay, this run lower and then shift in market structure. Where does that occur? Right there. That candle right there. It's a shift in market structure. What took place? The sell stops or sell side liquidity resting below here has been purged. So if we take this level here, put it right there. I told you when we were here to put that level, the blue shaded area on your hourly chart, and to note that. If it was up here and I tell you down here, where's my bias? Down. How far? To that fair value gap. This return to this order block, the market will want to do that. Once it does that, it accumulates buying opportunities. Let me say it better. It provides smart money to accumulate long positions when it returns to this. The algorithm is not waiting for smart traders to buy, and their buying is not propelling price higher. It's going down there based on time. It goes down to it here, pulls away from it, and goes down to it one more time. It's spending time allowing individuals that are privy to what I'm teaching you, what I'm showing you. There are people that are waiting for this opportunity. That is what they're paid to do. They are bank traders. But this run here, did it take out that high? On this run here, away from the order block, when it has a shift in market structure on that candle right there, when it moved up, did it take out that high? No. What did it leave there? Buy side. I was talking to you earlier, and you'll hear it in the recording, you'll see it in the recording. I mentioned that there's buy side here. Be mindful of that. Okay, and I went back to my conversation. The market drops back down into the order block. The algorithm offers the opportunity for traders that are looking for it to get in. Reprices higher, rejection block, retraces back down to the order block. Once more, what's it doing? It's allowing smart money to accumulate inside the order block. What else is it doing? For supply and demand, folks, fasten your seatbelts. We're cutting through some candles. Oh no, we're going back into that area of inefficiency. It was inefficient in what? Sell side. It went up. It offered it here. Okay. Is this balanced? This range here, is this range here balanced at that point? No. It's only balanced when it comes to it and leaves it. Now it's a balanced price range. This is an entirely different endeavor of running out liquidity that's formed here. It does not cancel this out. If you've gone through my core content, I teach you the PDRA matrix, and there is a 20, 40, and 60-day look back. And there's a 20 and 40, 60-day cast forward. The algorithm refers to things in that scope. So it trades down into the old fair value gap. What is it offering? Sell side again, here, and the order block. So how many factors do you have here leading to the likelihood of these relative equal highs, much like they were over here? What's above here? The same thing we have here from a narrative. We have buy side. What did price do from here? Drop down to what? To that low. Why did it do that? It took out sell side. Why would it be advantageous for the algorithm to reprice all the way down there? You're trying to tell me that only short sellers came in here. Nobody bought. And that's what drove price down exactly to the fair value gap that I outlined beforehand. But this movement here was the catalyst that sent us up into the buy side liquidity that I talked about in this live stream. That's where it's going to go next. What does that mean? It's not going below that low. Your focus was placed up here. Did it not do it? It did. Is it a big deal? No. But to a new student, for a new viewer, a casual viewer, well, that was kind of lucky. We get lucky a lot around here. Like it's a reoccurring phenomenon around here. I don't personally believe in luck, but it is what it is. But then we run from the order block up to and through that buy side liquidity. Runs above it, comes back down, works inside this range here. What's this down close candle? What's this right here? It's the same thing this is. It's an order block, okay? It's a down close candle prior to the change in the state of delivery, which is occurring right at that opening price. Extend that out in time. As soon as that price is touched and crossed to the upside, that is equivalent to a market structure shift. At that moment, this entire range here becomes sensitive to future returns to it. And I'll explain that in a minute. Man, ICT's pulling out a clinic, a price action clinic today. So down close candle, displacement to the to the upside. Watch that opening price. Why is the opening price? Well, because there's no wick. Well, why did you use the opening price down here, ICT? Didn't think I'd get back to that, did you? Why didn't you do it on the wick? Because whenever it's a short little stubby wick like that, I just immediately go right to the opening price. That's just because I've traded Forex, and Forex has a lot of spread issues, and that was where I adopted the rule set. There it is. But the hard and fast rule is if it's a really small little wick, just go to the body's opening. Market trades down into it here. Look how much around the midpoint of that candle, which was mean threshold. Half of a gap or inefficiency is consequent encroachment. It's the midpoint. If we have a order block, that's not a gap. That's not a fair value gap. It's a specific range in one candle. You split that in half, that's mean threshold. Look where they're going right here with these candles. Boom, half, 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 half. And then breaks higher. What's occurring right on this candle? Let me zoom in here because I want you to really get this. when we leave this consolidation inside this order block, okay, it drops down into it here. Mean threshold is half of the order block, so half of this range. And I'll show you that. This is what you want to do with your fair value gaps and what you think is an order block. So 40.27 even. Okay, 40.27 even. In my mind, I'm watching on a bullish order block, I'm watching the high to the midpoint. I want to see it show a willingness to support price, preferably hit it and quit it and run the other direction real quick. That's what I'm really looking for. But if it starts doing this, and as long as it's respecting that midpoint down here, I'm okay with it. I'm more specifically going to be watching if it starts to consolidate. I'm going to go in with like 6 contracts. I'm doing my typical go in, I buy 6 contracts, and I'm going to try to parlay it up and build a bigger position. What would I do? In this instance, using the order block, I'm going in right there at that price. I'd be going long on the first return to it there. So I would go long 6 contracts there. As it's digging down, I'm going to watch. Does it want to go to the mean threshold? Mean threshold is half of an order block, or half of a breaker, or half of a mitigation block. And go back through my core content and you'll see all that stuff. It's on the YouTube channel. Then I would buy 3 right here on this candle as it hits the mean threshold. So now would be long 9 contracts. If it runs like it does here, and then one more time pumps into it one more time, then I'll do my one last contract, and I'd be long net 10 contracts. 6, 3, 1. Hoping that I can get the little wick through, the midpoint, trusting that it isn't going to go the other side. See, you're thinking, how do you know, ICT? Didn't think I was going to know that, did you? How can you trust it, ICT? Experience, knowing that it's likely to do what I'm explaining here, and also being comfortable with being wrong. Because I can be wrong and be profitable. I can be right and be not as profitable as I should have been. There's a gray area where experience dictates the outcome. And I don't make any sugar-coated claims to make you not understand. It's going to take you work to study this. But over time, you'll see it, and time does its work. But when we see this range here, the midpoint of the order block, once it leaves it, okay, once it leaves that, what's this candle right here? This is a propulsion block. It's an order block within this order block. So it's a nested level. I love this formation. I love it. Let me show you why I love it. What's the opening price? What's the opening price on that candle right there? You should see it right up here. 4029.25. Okay, 4,029 and a quarter. That price to its high, right in here, that is one of the most sensitive bullish order blocks, responsive, quick, sudden, like you want to see a dynamic movement, it's going to really do it on this. Like, show me the order blocks that work. Well, here's that lesson. Here's that lesson, folks. Go back and just remember that we're talking about the propulsion block. This opening price to its high, that is the absolute most sensitive area in order block theory. What do you see? What's the opening price of this candle? 4,029 and a quarter. It goes through it. It leaves it on this candle. Does it not? Yes. The next candle we open here, what's the low of that candle? You're looking at this price right here. What's the low? 4029.25. Wait a minute. Deja vu. Something different here. No, it's exactly the same. The opening price, 4029.25. That again is exactly what I taught you in those core content lessons. Those videos were produced in 2016. It's logic that I coined in 1996. It's never been in any books. It's never been taught until I released it. You cannot improve upon perfect. You can't improve upon it. It doesn't fluctuate. It doesn't fall short of it. It goes right to the tick. And it does what? It delivers exactly the logic I teach you for a propulsion block. The run in price here, you have several things you can look at. You have the buy side relative equal highs here. So we have buy side here. And also, what is the highest? Look in here. Look in this area here. What is the highest closing price? What's the highest closing price? Right there. I'm going to walk through the PD array matrix with you, okay? There. And what else do you have? What's the highest high? Right there. So this high, what have I taught you about that? Wicks are gaps. What? Wicks are gaps. Midpoint of that gap is consequent encroachment. It's 4,036 even. What is the closing price on that candle? 4,036 even. Yes, there's a small little wick. I don't care about that. I'm caring more specifically about the bodies, because the bodies are going to tell you the narrative. The wicks are where the damage is done. The bodies are what I'm looking for. That's telling me the storyline. What's the opening price of the next candle? 4,036 even. Can you improve upon that? No. What happens after that? Recedes and goes lower. Does it offer from this point here, buying into the propulsion block, from here to the first rejection block, right here? That's the first of your premium arrays. Does it offer 5 handles there? Yes. Why do you think I've been telling you 5 handles? 5 handles is all over the place intraday. It's all over the place. There's so many opportunities to get that. It's very forgiving for folks that miss a move. You can find it again if you're using a 1-minute chart. Let's go back to the propulsion block. Right in here. What does it leave? What is that? Let me do it this way so you can see it. It's a fair value gap, isn't it? How do you know it's going to stay open? The propulsion block. This shouldn't stay open. It should stay, it should stay open. It should not fill in. This would act as what? A breakaway gap. So if this is breaking away, I'm going to expect what? Price delivery to be more bullish candles, very little retracement, and maybe 1 or 2 down close candles. Everything else be what? Bullish delivery. Buy side being offered. How many down close candles do you have from the propulsion block to the consequent encroachment of the wick? You have 1 down close candle. Why is that important? You need to know the difference between signatures that are going to be favorable for you. If you start seeing a lot of consolidation and down close candles forming and booking in a price run that you're in, chances are you're probably going to get a retracement and come back on your stop loss, or it's not going to go in your favor anyway. So I'm looking at how does price continuously deliver. Is it giving me bullish candles? Is it staying bullish each time? With the exception of this candle here, every candle was bullish. And I'm not worrying about all the little whipsaws back and forth, because I'm not going to ram my stop loss up there, theoretically, because I want to see it do what? I wouldn't even roll my stop up until this short-term high was taken out, because above that is what? A very small pool of buy-side liquidity. Buy stops. Anyone that's short, they would have trailed it from here to here. And then we move back into consolidation. And we're entering what time of day? Noon. That's lunch. I teach that most of the time, you're going to be squaring your position before noon. I'm not saying that I don't trade in lunch. I do. I have done it. But as a developing student, you don't want to be doing that because you don't know the characteristics that are part of that. All right, we're in the noon lunch hour. So if we are to look at the rest of the day, okay, we've moved in a range that it looks as if we've already taken sell side here with this drop. This is a little too clean. I'm not trading the rest of the day, okay? But I would watch this area here. If it doesn't run for it, going into the 2 o'clock hour and it leaves this low intact, if this low stays intact, if it doesn't breach that low, I would look for the last hour trading to try to attack this. That's how I would look at it. Now, that's just forecasting. That's not trading. That's not saying it's absolutely going to pan out that way. That's how I would plan. Like I would go get something to eat and come back to my charts at 1:30 and then see, does everything I just said exist still in the chart? If this low stays intact and we haven't gone below it, and this stays like it is, nothing piercing it, then I would expect the final hour trading to reach for 40.38. And I would plan my afternoon like that. And if I come back and it has done that, then I would do nothing for the last part of the day. So that's how I plan my trades. That's how I plan my sessions. I think about the logic and I just mapped out why I just said what I said. And if it's anything other than that, I'm not interested. It can do something. It could completely collapse and go down below 4,000 from where we are right now. That's not my trade. I'm not in that. I'm not participating in that. I'm not claiming to be in every single swing. I am claiming that you can find very specific surgical strikes with precision, and it doesn't need to have any indicator. Nothing that's going to be, in addition to. Anything that I apply to my chart is just lipstick to accentuate, dial in your attention to a very specific element of price. I don't have it on my chart. It's an adjustment for me to have these things while I'm watching price. I annotate them and then I turn my attention to my other charts. Because if I look at things I draw on the chart, it's a distraction to me. Your frame of reference needs to be anchored on some limitation in price action, not like everything that's been explained here doesn't even factor in all this over here. This is already done. This fractal's done. I've already outlined it and you see when it's done. I've given you my expectation for the afternoon. This low, we ran out during the lunch hour. It only took it 2 minutes to get into lunch hour to do it. So this drop down, I like that. I like the fact that we have relative equal highs. I'm not trying to call a top in the marketplace, so I'm not going to arm wrestle that logic. What retail tries to do, they try to pick tops and try to pick bottoms. I don't do that. I look for where the obvious liquidity is, and the low here, they ripped through that in this low here. So we ran through that. This is not smooth anymore. It's jagged. Where's their smooth levels? It's here. And if it was to drop through this low, I don't do anything. I just take the rest of the day off. Consistently profitable traders, I'm going to say this and I'm closing, they have processes to get into a trade. That's without saying, obviously. They also have processes that keep them out of the marketplace for various reasons. It may be an economic report that's due that's going to invite a lot of volatility, or it may be a expectation that the market does in fact do nothing, and it's not imperative for them to engage right now, and they'll wait for a later time for the market to get more animated, and then they'll participate then. They're not, and I'm not, and my students that have adopted this mindset, we're not worrying about missing a move. And if a move was to manifest itself and rip and tear off and do something phenomenal, and we aren't a part of it, we're not grieving over that. Because we know that we can find repeating phenomena in price action that are rooted in statistical probabilities that you can go back and see many times of that very thing occurring. But it's not the same thing as saying, like I've taught, and there's a joker out there on Twitter right now trying to make a name for himself because he's crunched some numbers. In my lectures, I teach that when it's in a bearish model, okay, it's in a sell model. The high of the week tends to form 70% of the time on Tuesday. If you take every week indiscriminately and look for, does it form the high on Tuesday between 2 o'clock and 4 o'clock in the morning, you're going to get data that doesn't support that. You don't even define what a sell model is. I do. So having that mindset, I'm not going out there every day thinking the high of the week is going to be on Tuesday or the low of the week is going to be on Tuesday between 2 o'clock and 4 o'clock in the morning. There has to be other factors that filter that. I just want to scan through real quick before I close. NASDAQ is ugly. And the Dow. Yeah. Look at this. Look at this. You should be seeing the NASDAQ. That price action on the right-hand side, that right there is a day that says, don't touch me. Now, you might see that and think something else, but I'm saying that right there tells me, don't touch me. And because I say don't touch the NASDAQ, what's closely correlated to NASDAQ? ES. So if it's a no touch on NASDAQ, then it's a no touch on what? ES. They have to confirm one another. If I don't see a sustained move in all three of the averages, and here's the Dow. If I don't see a justification for them to move in agreement, and that gives me the market breadth to trust that we have a sustainable price move underway. If one of them acts like a sick sister, this one here is like a hobbling, bum leg. It's not doing all that much in terms of symmetry. It's just all over the place. Looks like a heart attack. That's your warning sign that you're probably trading with low probability conditions. So going back to ES, while I do believe that those highs could be taken out, because of what I just shown you in NASDAQ, I'm probably going to be incorrect. So I've subscribed to something publicly, but I'm also communicating the reasons why I personally will not be going back in to take a trade because of what we're seeing in NASDAQ. Now, doesn't that disarm you? It gives you a reason to say, okay, I'm not going to be doing something and I'm okay with not doing it. I don't know what I'm doing, but I feel like I'm missing something. Big difference, isn't it? So that type of feeling, that comfort comes from someone that's been doing it for a while. And traders that have been subscribing to me on my Twitter feed, they have been benefiting from that because they've seen a lot of, things that would otherwise be distracting, not really providing any clarity as to what they would expect, as a trader, what they would be doing as a trader and how to think as a trader and how to conduct themselves and think.